traders, for today's trade we are looking at a neutral option play known as an iron condor in chipmaker Nvidia, which is set to report earnings on Wednesday after the closing bell. The stock has been drifting lower towards support at its 21-day line over the past few days alongside the market's pullback. Shares catapulted a solid 63% higher from the start of January to its February 14th highs. Nvidia's relative strength line has also been churning higher alongside the stock price. Blue volume bar spikes also indicate that this rally has some strong volume behind it, a bullish sign. Sales and earnings have contracted on a year-over-year basis in the most recent quarters. Analysts expect earnings for 2023 to also decline. But that's to be followed by a rise in 2024. On Wednesday, analysts expect EPS to come in at 80 cents a share on revenue of roughly $6 billion. So how do we take this upcoming earnings event and construct an option trade around it? The first thing to note is that Nvidia stock has stayed within the expected range following 5 of the last 6 earnings announcements. For tomorrow's earnings report, Nvidia is anticipated to stay in an 8% range up or down. So traders who think the stock will not move too much following this report could look to put on an iron condor trade. As a reminder, an iron condor is a combination of a bull put spread and a bear call spread. The idea with this trade is to profit from the time decay while expecting the stock will not move too much in either direction. An iron condor is a risk-defined strategy, which means that you know your maximum loss potential ahead of time and it's not unlimited. This is a great way to get exposure to a stock without taking directional risk. So with all that said, let's take a look at my trading platform and set up this trade.
So for this trade here in Nvidia, we are going to be using a February 24th expiration. And for the bull put spread, we are looking to sell the 200 put and buy the 195 put. So that creates the bull put spread part of the iron condor. Then for the bear call spread, we're going to create this by selling the 230 call and buying the 235 call. And there you have it. This is your iron condor.
We'll be using the February 24th expiration for all legs of this trade. And for the bull put spread, we could sell the 200 put and buy the 195 put. Then the bear call spread could be placed by selling the 230 call and buying the 235 call. In total, this iron condor will generate around $2.05 per contract or $205 of premium. The profit zone ranges between $197.95 and $232.05. This can be calculated by taking the short strikes and adding or subtracting the premium received. As both spreads are $5 wide, the maximum risk in this trade is $295. If we take the premium divided by the maximum risk, this iron condor has the potential to return around 69%. If price action stabilizes in this stock, then this iron condor will pay off. But if Nvidia makes a bigger than expected move, the trade will suffer losses. Remember that trades held over earnings allow for very little room for adjusting, so they can be pretty hit or miss. But Nvidia, like I said before, has stayed within its expected range for the last 5 out of 6 earnings releases. Although we know past performance doesn't guarantee future performance, these patterns help us weigh in on this decision. As always, remember that if you're new to options, please make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. And be sure to join us for our regular options content here where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.